Lesson number 4, marking to market. I have to warn you, this is going to be tough, so take your time, and if you don't understand something, go back and listen to it again. Here is what you will learn in this lesson. What is marking to market? How do margins work? A first methodology. Examples of marking to market based on real data. A case study, September 11, 2001, a huge stress test for marking to market. A different methodology for margins calculations. The management of counterparty insolvency risk requires the application of a precise methodology called marking to market. The marking to market applies to all regulated derivatives and involves a daily settlement of profits and losses. Every day, when the market closes, nominal profits are immediately credited, nominal losses are immediately paid. But to be stringent, the intermediaries manage this process in real time now. But for the moment, we are proceeding with a simplification of reality, so as not to immediately add an unnecessary complexity. Daily profits and losses are managed by the clearinghouse, CH from now on, which acts as the counterpart of any position. The clearinghouse provides to pay off the debts of those who lose money, paying immediately those who are earning money. Then, obviously, it refers to the investors who have to pay their own losses, passing through their respective intermediaries. This means that the clearinghouse is paid by the bank, and the bank is paid by the customer. In doing so, the clearinghouse guarantees the successful completion of all operations, ensuring the payment of profits to those who must be paid. How do margins work? Unfortunately, the answer to this question is not unique, to be honest. In fact, it depends on the market we are talking about and on the intermediary we use for our trading, because some intermediary apply some methodology, some others apply different methodologies. Indeed, the intermediary has the right to decide whether to apply the margining as it is suggested by the clearinghouse, or if he wants to apply a higher margin as a further precaution. And this is a first fact. But beyond this, the intermediaries that operate in different countries apply different mechanisms, so much so that the methodologies applied by some are often unknown to others. If you tried, for instance, to ask an Italian intermediary what maintenance margins are and how they work, most likely they wouldn't even know what you're talking about. International brokers such as Interactive Brokers, on the other hand, apply precisely the method based on maintenance margins. In the next slides, we will see how both mechanisms work, without going into too much details, but at a conceptual level. So, method number 1, the initial margin, which we discussed earlier, serves as an initial guarantee deposit and serves to cover a risk determined on a statistical basis. Indeed, it represents the maximum expected loss from one day to another on the underlying in question. This estimate takes into account the effect that a large rise or fall would have on the portfolio of a certain investor. The entity in question, to put it briefly, takes into account what, on the basis of historical data, can happen within 1, 2, or 3 days starting from the current situation, and applies the worst-case scenario of the 3. So, looking at it from the point of view of a long position on a futures, the problem could be what if the underlying drops and how much it can drop within 1, 2, or 3 working days. Looking at historical data, you can state that, just to say, over 1 or 2 or 3 days, the maximum potential loss for the stock index, for the Italian stock index, is 12%, then that is a good measure of the maximum potential risk one day to another. From the point of view of the short seller of the futures, it's the opposite. The problem is, what if the underlying goes up? How much could it go up on the basis of historical data? You can make an analysis of historical data and you come out with the fact that on the basis of the last, just to say, 15 years of data, the maximum positive variation in one day of a stock index has been 10%, then 10% is a good measure of what could happen tomorrow. And so it could be a good measure of the initial margin. Since both counterparties to a contract are exposed to a risk of insolvency, they are both required to deposit the initial margin. When a transaction is opened, both the buyer and the writer deposit the percentage established by the clearinghouse by way of coverage of the statistical risk of the open position on a daily basis. Subsequently, depending on how the price of the underlying evolves, and to keep the risk fully under control, positions are constantly monitored day after day. At the end of each session, the closing price of the underlying is compared with the closing price of the previous day, and the risk of the existing positions is redetermined. First of all, the initial margin is adjusted according to the new percentage risk value. Don't be afraid, in a while we will see a numerical example that will make things much easier to understand. Therefore, any profits are credited and any losses are debited. So, let's recap all of this. In the moment you open the position, you deposit the initial margin. The initial margin is calculated as a fraction of the value of the contract, and that fraction is calculated on the basis of a statistical calculation. And it's a measure of risk, of the expected risk. Then, at the end of the day, if the price of the underlying moved, you have to recalculate the initial margin because the initial margin is a fraction of the value of the contract. If the price of the underlying changes, the value of the contract changes. So you have to recalculate the initial margin. And here you have the initial margin adjusted. Then, depending on what happened during a single day, you open the long position on the futures, the price increased, then you are theoretically gaining money, but that theoretical gain is immediately credited to your account, and that is the variation margin. You have a long position in the futures, the price of the underlying decreases, the price of the futures decreases as well, you are theoretically losing money, you have to immediately pay that theoretical loss. The initial margin is expressed as a percentage of the contract value. This implies that every time the closing price of a certain day differs from that of the previous day, the value of the initial margin changes, so it must be recalculated. The value of the margin may also change due to an increase in the percentage of risk. Read it, the volatility of the underlying, calculated automatically by the stock exchange control systems. And the two effects may add up or offset each other. If, just to say, you have a long position in a stock index futures, the price goes up, but the volatility reduces, what you have is that the initial margin expressed as a percentage of the contract value will increase due to the fact that the price of the underlying increased. But the component based on the volatility of the underlying would reduce due to the fact that the volatility has been reduced. So the two effects could offset each other. On the other hand, you have a long position in the futures, the price of the underlying drops, the volatility increases, the reduction in the price of the underlying would lead to a reduction in the initial margin, but the increase in the volatility leads to a higher initial margin. So once again, the two effects offset each other. In other words, the value of the initial margin varies both as a function of the price trend of the underlying and as a function of the volatility of the underlying, on which the systems instantly and automatically adapt the percentage of risk on which the calculation is made. Every evening, there is therefore an adjustment of the value of the initial margin. If it is reduced, a certain amount of money is returned to the investor. Vice versa if it increases. In summary, the initial margin is only a guarantee deposit which is adjusted day by day based on the evolution of price and risk. When the position is closed, the initial margin, including any adjustments, is fully returned. The daily variation margins are instead the real profit or loss of a position. They are credits or debts that are paid daily in order not to affect the initial margin, which in this way can always perform its functions of covering risks in a timely and consistent manner with the current market situation. Let's look finally at a couple of examples. Example number one, a long trade on the FTSE index futures. Let's first look at the note here in yellow. Note, for the sake of this example, a fixed initial margin value of 10.25% has been accounted for. It's just to make things easier, because the alternative could be every day to recalculate the component of risk expressed by the volatility of the underlying and the component based on the value of the underlying. Here we are applying a simplification because otherwise we would have to add too many complications to the calculations. So this trade opened on August 21st, 2014, along at the breakout of this previous relative maximum. So buy here one contract for 19,705 points. So on day one, August 21st, we have a price 19,705, the initial margin 10,098 euros,81%. This is given by 19,705 points times 5 euros a point times 10.25%. It means 10,098.81 and something, but let's not consider it. There is no initial margin adjustment in the moment of purchase. There are no variation margins in the moment of purchase. Let's ignore the last two columns for now. We will see all of this later on when I will show you the stress test on the basis of what happened on September 11, 2001. This happens on purchase of the futures contract. But the same day, once again, August the 21st, you see, same day, when the market closes, we have a new price, 19,880 points. This means that the value of the contract has changed, and so we have to recalculate the initial margin. Indeed, 19,880 times 5 euros each times 10.25% means 10,188.50. This means that another 89.69 euros are taken from my account and deposited as initial margin adjustment in the margin account. But in the same time, I have a profit of 175 points. I purchased for 19,705. Now it is valued 19,880. So I have a profit of 175 points times 5 euros each. It means I am credited 875 euros on my account immediately. So in the moment of purchase, I deposit 10,098.81. At the end of the day, I have to deposit another 89 euros and something, and I have a credit of 875 immediately credited on my account. Then it goes on. The next day, August the 22nd, the closing price 19,845, 35 points less than the previous day. The initial margin is slightly reduced, of course, a lower price, a lower value, a lower amount of risk. 10.25% is fixed. So 19,845 times 5 euros each times 10.25%, 10,170 euros,56. And this means that 17 euros and something are returned to my account. And at the same time, I have a loss equal to 175 euros, 35 points times 5 euros each. One day more. August the 25th, The closing price 20,280. The initial margin 20,280 times 5 times 10.25%, 10,393.50. Another 222 euros and something are taken from my account and put into the margin account as initial margin adjustment. But in the same moment, I have a credit of 2,175 euros due to variation margin. Another day on August the 26th, price at the end of the day 20,530, a new value of the initial margin, a new initial margin adjustment, and a new variation margin immediately credited on my account. Another day on August the 27th, 20,640, initial margin higher than the previous day, a new initial margin adjustment, a new variation margin. Then on August the 28th, I have a stop profit at the breakdown of the previous day's minimum. I get out for 20,470, no more initial margin, no more initial margin adjustments. All this money is returned to my account because it was not an expense but just a safe deposit. And I have a last variation margin because the previous day it was 20,640. I am getting out for 20,470. So I have a loss of 170 points times 5 euros each, minus 850. The net result of the trade is the algebraic sum of all the daily variation margin, 3,825 euros of profit. On what money? Not the initial margin, 10,098.81, but the maximum need of money in the moment of the maximum price of the underlying, 20,640, 10,578 euros deposited as initial margin. So 3,825 on 10,578 is the net result of the trade. What happens with the short trade on the FTSE MIB index futures? Short here at the breakdown of this minimum for 20,775 on July the 31st, 2014. We sell for 20,775. The initial margin is 20,775 times 5 euros each times 10.25%. That is 10,647.19. No initial margin adjustment, no variation margin in the moment of short selling. But at the end of the day, the closing price is 20,505. I have opened a short position, so I am gaining money, 270 points times 5 euros each, a positive variation margin of 1,350, and a reduction in the initial margin because a lower price means a lower value of the contract. So a lower value of the initial margin. So I am credited 1,350 euros as variation margin, and 138 euros are released and come back to my regular account. The same happens the next day. The price drops again, 250 points, 255 points, times 5 euros each. I have a daily variation margin of 1,275 euros immediately credited on my account, and 130.69 are released and come back to my account. Then a day with a slight bounce, only 30 points, negative daily variation margins, minus 150 euros, a little negative variation in the initial margin adjustment. The minus means that money gets out of my account. So for me, it's, let's call it an expense. So let's call it an exit from my account. On August the 5th, the position is closed for 20,405, maximum of the previous day. If it breaks up, let's get out. Unfortunately, this was a mistake, but I couldn't know in that moment. Anyway, no initial margin, no initial margin adjustment, one last variation margin. I lost 125 points in respect to the previous day's close, so a variation margin of minus 625 euros, and the algebraic sum of all these variation margins is 1,850 of gain. So by all means, what happens every day is exactly like you closed your positions for the closing price and reopen them for the same closing price. Indeed, every day you are immediately credited your profits, you are immediately debited your losses. That's exactly as you closed your positions and reopened them for the same price. Let's see what could have happened on September 11, 2001 with a long trade in futures. The aim of this example is to prove that if this mechanism is properly applied, there is absolutely no insolvency risk in the market. Okay, so what you're looking at is the chart of the FTSE index. It's the weekly bar chart over the period between August and September 2001. I am using the weekly bar chart because this way we can make it faster. Otherwise, we would have to calculate all the daily variation margins day after day after day after day. In this way, in just 4 calculations, we are going to see what I want you to understand. So let's assume that here, let's call this day 1, August the 31st, 2001, I decided to purchase a futures on the stock index on the Italian FTSE index, expecting that this bar could lead to a new uptrend. So I purchased a futures for 35,875 points. So let's call day 1, 2, 3, 4, 5. Indeed, we have to do 2 calculations. The first day, let's put here the closing price, let's put here the initial margin, let's put here the initial margin adjustments, let's put here the variation, and let's put here the available money, which we will see later. So in the moment of purchase, the price is 35,875. 35,875. At that time, the initial margin was only 9%. This means that the initial safe deposit was lower than the one you are required to deposit today. And even in this situation, with a lower coverage of risks, the proper application of the mark-to-market would have avoided any risk of insolvency. Let me show you how. The initial margin in this case would have been 35,875 times 5 euros each times the initial margin of 9%, 16,143.75. The initial margin adjustment would have been 0, the initial margin would have been 0. Then, at the end of day 1, which in this case is week 1, but it doesn't matter, 34,643. 34,643. Initial margin would have been 15,585, meaning that I would have had an initial margin adjustment of this minus this, plus 554 euros that would have come back to my account. But at the same time, I would have had a loss equal to 34,643 minus 35,875 times 5 as variation margin, minus 6,160 euros. Then, day number 2, 31,805, 31,805. A new initial margin, 14,312. And an initial margin adjustment, 1,275, that would have come back to my regular account, but in the same moment I would have paid 14,190 as variation margin. Day number 3, close price 27,681, 27,681. Initial margin 12,456, adjustment plus 1,855, variation minus 20,620. Day number 4, 23,896, 23,896. Plus 1,700 on my account, minus 18,925 as variation margin. On day number 5, I get out of the trade for the opening price 25,790, 25,790. It means that we have no longer initial margin, we have no longer initial margin adjustment, but we have a plus 9,470 on the account. So just to recap, day after day, we have an initial margin that is recalculated on the value of the underlying in that moment. Then we have an initial margin adjustment. It means that we can have more money to deposit or less money to deposit. And depending on the sign of this variation, we can be restituted of some money, or we can be asked to deposit some more money amount. But that is just a safe deposit, not an expense. The expense is the variation margin. The debit or the credit is the variation margin. The variation margin is the difference between the two closing prices times the value of a point. In this situation, 6,100, 14,000, 20,000, 18,000, 9,000. Okay, let's now introduce available money. Let's assume that in the beginning, the available money is 100,000 euros. What happens in the moment of purchase? We have the available money minus the initial margin. This is the available money in our account. Okay, because 16,143 is, yes, just a safe deposit, but it is credited to our margin account, which we cannot open, which we cannot manage. It's managed by the bank. So it's money that in that moment are not available. The available money is 83,856. Then what happens the next day? This was the balance at the beginning of purchase of the futures. At the end of the day, we have a credit of 554.4 due to the initial margin adjustment, plus a debit of 6,160 as variation margin. So the net available money now is 78,250.65. What then? Another day passes and we have a new value of available money, 78,250 plus 1,277 minus 14,190. Another day passes, 46,573 available. Another day passes, 29,351. And in the end, what we get is the previous day's balance plus all the money restituted, because the initial margin gets restituted in the moment we close the position, plus the last variation margin. So in the end, we have left 49,575 euros. Let's check it in another way. The final profit and loss of the position is 50,525 euros. And from the initial available money, it means that we are left with 49,575. In a situation like this, no problems are faced even if the position evolves in a very unfavorable way. When does the problem arise? The problem arises when you end your money. when you end up at the end of some day with a negative balance in your account. So let's see, for example, what could have happened if the available money in the beginning was only 70,000 euros. At some day, the final balance would have been negative, minus 648. What if the initial available money was 50,000 euros? It would be negative a day before. So what happens here? What happens here is that as you get close to the end of the day, the bank warns you, you are in the red. You have to integrate your availability in your account, otherwise you have to close your positions. And if you don't close your positions before some time, let's say 5:10, 5:15 p.m. Italian time, in a market, the Italian derivatives market that closes at 5:45 today. So about half an hour before the closing of the day, the bank calls you and tells you, hey buddy, you are in the red. Either you close your position on your own or we will do it. This happens because the law allows the bank to close positions by force if the client doesn't do it on his own. So you get here, you are in the red, you decide to close your position, you close it for the closing price, just to say 27,681, you lose 20,620. But in the moment you close the position, this money amount, the previous day's initial margin, is fully released. So what you get is that the balance is minus 3,426.45 plus 14,312. So in the end, you are left with 10,885 euros on your account. Let me say this again, because I understand this is not very easy. Let's assume that you get close to the end of this day, day number 3. The market is around 27,700 points. You are suffering a potential variation margin higher than the money available in your account. In your account, there's only 15,000 left. You are suffering a loss 20,000, so you are out for some money amount. Okay? You know that if the market stopped now, if the day ended now, you would be in the red. The banks knows it because the systems of the bank, the risk management systems of the bank, automatically warn the bank, you have a client that is in the red. So call him. The bank calls you and tells you, either you close your position on your own or we will do it by force. So in that moment, what you reasonably have to do is to close your position. You close your position for what? Let's say for 27,681, there is no initial margin anymore. This money amount is released. But to be stringent, what is released is the initial margin deposited the day before, because till this day is finished, this is the money amount deposited as a guarantee to cover your risks. Okay, so you have 14,312 euros deposited. So in the moment you close the position at 27,681, you have one last variation margin of minus 20,620. So in respect with the previous days, you have 15,337.75, the available money the previous day, plus the variation margin you are suffering today, plus the initial margin deposited yesterday, which now is released. Final result is plus 9,030. I made a little mistake in the previous calculation. Okay, so once again, you close the position on day 3 for 27,681. In respect with the previous day, you have a negative variation margin equal to 20,620. The available money the previous day was 15,337.75. And the money deposited for the coverage of the risk one day to the next one was 14,312.25. So, in the end, what you have is the previous day's available money, 15,000 and something, plus the negative daily variation margin, minus 20,000 and something, plus the initial margin deposited the previous day, 14,300 and something, that now gets released, restituted. So what you're left with is 9,030 euros. So you made a huge mistake. Your trade was really a very bad one. But still, you keep money in your account. You are not in the red. You are in the red in terms of theoretically available money. But in the moment you close the position, the initial margin is restituted, you are not in the red anymore. This is what marking to market is for, to prevent that you go in the red. And if you apply it properly, and as you can see, it just takes a simple Excel spreadsheet, you never get in the red. What would happen here, just to say, is that you end up with not enough money to keep going on, but you're not in the red. You still have money in your account. When could all of this go wrong? In some so specific situations that the probability to face them is very close to zero. Let's see, for example, what could happen. In a moment like, let me go back to the previous situation, and let's assume that the available money in the beginning was 53,426.45. Exactly. So in the beginning, your available money is 53,426.45. On day 3, the available money is 0. But 0 doesn't mean in the red. So the bank cannot tell you anything. You are not losing money you don't have. You are having a 0 balance in your account, but it is not a loss. Who can tell that the market tomorrow will not bounce? Okay, so at the end of day 3, you have 0 on the account, but you still have 12,556 deposited as a safe deposit in the margin account. So you can say, let's wait another day. Let's hope that the market will bounce. But the market doesn't bounce. The market keeps going down. And it goes down, causing an additional loss of 18,926. So your final balance, given by the fact that you have a daily variation margin of minus 18,925, but you have an initial margin adjustment of plus 1,703. So you end up with minus 17,221.75. Even if you close your position, you get back only 12,456. So here you are in the red, because this plus this means you are losing 4,765 euros. So it can happen. Actually, it can happen that even with a properly applied marking to market, you get in the red. But the odds to be in that situation are very, very close to zero. Also because going back then, in 2001, the initial margin was fixed at 9%. The exchange had the chance to increase it, but it would have taken some days because the change in the initial margin was not instantaneous. The risk management office of the stock exchange had to do a meeting. What are we going to do? Are we going to increase the margin? How much? From when? For how many days? And so on. So it took quite a long time to become operative. Now the systems automatically adapt the initial margin depending on the volatility of the market. So should this happen today, in a few days the initial margin would be raised up to 15%. And being 15% the initial margin, you would go in the red much faster than if the initial margin was only a 9%. So the system once again is made to prevent any problem that could be caused by the market volatility. So let's go back to the presentation and speak of sizable losses. In some particular situations, it may happen that open positions in futures evolve in an extremely unfavorable way, causing requests for payments of significant daily variation margins. Consider, for example, September 2001. In those days, investors who had long open positions had to face considerable variation margins, even in a system that adopted a fixed margin of only 9%. The deposit of the margins is requested by the control authorities of the correct execution of the trading on the markets, so it is mandatory. You cannot decide not to apply margins and marking to market. If at the close of a certain day an investor does not hold sufficient money in the account to cover the negative variation margins, the intermediary warns him that he can only do two things. Either he transfers funds from other accounts, but the transfer must take immediate effect, or the day after on opening he is required to close his positions, or the bank will intervene by force. But to tell the truth, some intermediaries do not even wait for the end of the day to signal to the client that he must intervene. At 5:15 p.m. they tell him to remedy the situation, which is monitored in real time and not only at the end of the day. If the customer does not intervene within a certain time, a few minutes before the end of the day, the intermediary can intervene automatically. It has been shown that the meticulous application of marking to market prevents the risk of insolvency in almost all cases. With the current system, there is a probability very close to 100% of not running into insolvencies. But of course, you have to apply the marking to market. Not all intermediaries do it properly, unfortunately. In order to clearly understand the speculative power of futures, it is sufficient to make some simple mathematical calculations on market data. Consider the Italian market. The average variation range, the distance between maximum and minimum, of the FTSE index futures price in the 2,469 days between June 1st, 2007 and March 31st, 2017 is 430 points. Some might argue that it would be better to look at it as a percentage, since making 400 points of variation when you are at 40,000 points is easier than when you are at 20,000 points. But this is not the case, because the correlation between the daily range and the index value is very low. So low that we can say that the two phenomena do not depend on each other at all. Well, if we add a trading system capable of making us profitably capture even just 25% of the daily price range, we could get an average daily profit of 107.5 points, or 537.5 euros if a single future contract was used in every trade. With what capital? Difficult to give an exact quantification, but we can make a cautionary estimate. If the initial margin were equal to 15% fixed, the average of the daily margin requested in the above time period would be around 16,100 euros. The average daily profit would therefore be equal to 33% on the money used. And as it often happens, as you already know, unfortunately you are not always on the right side of the market, so you could either gain a 3.33% on one single day or lose it. And that's why marking to market is so important. How do margins work? Method number 2. The second way for applying margins and marking to market is based on the so-called maintenance margin. The maintenance margin is an amount of money decided by the intermediary for each individual derivative instrument, which must always be present on the account of an investor in order to keep a position open on the instrument mentioned above. When a position on the derivative contract is open, an initial margin is taken, as in the case with the other methodology. The difference is that here the initial margin is often calculated as a fixed amount, not as a percentage of the contract value. Then the variation margin is applied to the open positions. Profits and losses are calculated and credited or debited on a daily basis and monitored in real time, as in the other case. To this is added the maintenance margin, which is the minimum amount of money that must remain on the account if the position evolves in the opposite direction to what was hoped for. If the variation margins bring the account balance below the maintenance margin, the positions can be automatically closed by the intermediary, unless the client provides to supplement his availabilities, either moving funds from other accounts or closing positions until the available money is higher than the requested level. In the end, the two methods are very similar. The first is based on an initial margin calculated as a percentage of the value of the contract, while the second is based on a fixed initial margin. But to be stringent, the amount of the fixed margin can be modified according to market conditions. When volatility increases, intermediaries tend to raise the values of the initial margin so as to always keep them consistent with the market risk. But while with the first method the change is instantaneous and automatic, with the second there is always a certain latency in the changes, since the risk management organizations must decide how much to modify the amounts, from which day the changes apply, and for how much time leave them in effect. In the first case, we also have a daily adjustment of the initial margin, which therefore always remains punctually referred to the contract value. With the first method, however, the safeguard mechanisms are activated only when the account balance is negative, while with the second method they are triggered when it falls below the maintenance margin, so this is more precautionary. It is therefore difficult to establish which of the two is better, but one thing we can say for sure: they are both very effective, and once again, if they are properly applied. For now it's all. Thank you for your attention.